Lease accounting changed significantly with the introduction of ASC 842 and IFRS 16, which were issued in 2016 and became effective for public companies in 2019 and private companies in 2020. What used to be a footnote disclosure is now a balance sheet level accounting requirement. And for many finance teams, that shift introduced new complexity, new risk, and new processes to manage. In this video, we'll break down what ASC 842 requires, how it impacts financial reporting, and what accounting teams need to understand to stay compliant. ASC 842 is the U.S. lease accounting standard issued by the Financial Accounting Standards Board. Its core goal is transparency. Under prior guidance, many operating leases were kept off the balance sheet, with future obligations disclosed only in the footnotes. ASC 842 changed that. Today, most leases must be recognized directly on the balance sheet through a right-of-use asset and a corresponding lease liability. This applies to both public and private companies and affects real estate, equipment, and embedded leases. IFRS 16 is the international counterpart to ASC 842. While both standards aim to bring leases onto the balance sheet, their structures differ. ASC 842 retains two classifications, operating leases and finance leases, while IFRS 16 uses a single lease model for lessees. For companies with global operations, understanding both standards is essential to ensure consistent reporting and audit alignment across jurisdictions. One of the most important changes under ASC 842 is balance sheet recognition. At the lease commencement date, companies record a right-of-use asset and a lease liability measured as the present value of future lease payments. This applies to both operating leases and finance leases, even though the income statement treatment differs. For accounting teams, this means lease data must be complete, accurate, and consistently measured across the portfolio. ASC 842 classifies leases as either operating or finance leases. Both appear on the balance sheet, but expense recognition differs. Operating leases typically result in a single lease cost recognized on a straight-line basis. Finance leases, which replace legacy capital lease accounting, result in separate interest expense and amortization of the right-of-use asset. Understanding this distinction is critical for accurate financial reporting and audit support. Another key concept under ASC 842 is the lease commencement date. This is the date the lessee gains control of the underlying asset, not necessarily the lease signing date. Errors here are common and can lead to misstated assets, liabilities, and expense timing, especially when construction delays or phased occupancy are involved. Even companies that technically comply with ASC 842 often face operational challenges. These include incomplete lease populations, spreadsheet-based calculations, inconsistent discount rates, and difficulty responding to audit requests. As portfolios grow, managing lease modifications, reassessments, and disclosures manually becomes increasingly risky and time-consuming. ASC 842 isn't a one-time compliance exercise. It requires ongoing monitoring, reassessment, and documentation. That's why many accounting teams move away from spreadsheets and toward centralized lease accounting systems to support accuracy, consistency, and audit readiness over time. ASC 842 fundamentally changed how leases are accounted for and reported. For accounting teams, success depends on understanding the standard, maintaining clean lease data, and applying consistent processes across the portfolio. If you're managing leases under ASC 842 or IFRS 16, getting the foundation right makes everything downstream, from close to audit, significantly easier.